So in today's session, we'll look at introduction to company accounts. So in the session, we'll try and understand the capital structure of a limited company, including the ordinary shares, the preference shares, and loan notes. Then we're going to also record the movements in the share capital and the share premium account. We'll define what a bonus issue and the rights issue is, as well as the advantages and disadvantages. Then we're also going to show how they are recorded in the statement of financial position. We'll also look at other reserves which may appear in the company statement of financial position. Then we'll record dividends in the ledger and the financial statements. Then finally we'll calculate and record finance costs and ledger accounts in the financial statements. You notice that most of what we'll be discussing is centered around the statement of financial position. So that's a pro forma of an income statement. You need to know this format of the income statement. This is what's been prescribed by IAS 1 presentation of financial statements, which is a standard which guides us on how the financial statements should be presented. You notice that the very last thing that you subtract in your accounts is the tax to get the profit for the year. Is that profit for the year which goes to the shareholders of the company after all the obligations and the company obligations have been settled in a particular financial year. The statement of financial position is divided into two sections. These two sections, the assets and the equity section, must always balance. The asset section is divided into two. It's divided into non-current assets and current assets. The non-current assets are those assets which you'll be using in the business for more than one financial period. The current assets are those which you are continuously replacing within a particular period. For example, inventories, you may be replacing inventories, some on a daily basis or on a weekly basis or on a monthly basis. The receivables will also keep on fluctuating as you sell on credit, and as some receivables settle their obligations. So the total of the non-current assets and the current assets is what gives us total assets. It's these total assets which should balance with the total equity and liability. You notice also that the total equity and liability is divided into two. It's divided into equity and liability. Is equity and liabilities. The liabilities are further divided into non-current liabilities and current liabilities. Under the equity section, we have the share capital, which is what the shareholders or the owners of the business have put into the business. We have the share premium, which we'll be discussing. We have the reserves and the retained earnings. So if we go back to the income statement, this profit for the year in the income statement, if it's not all taken out by the shareholders, if they leave some of the profit for the year in the company to be reinvested, that's the one which comes here as retained earnings. So retained earnings are simply profits which are coming from way back, which have been reinvested in the business. Then we have the non-current liabilities. These are borrowings of a long-term nature where the repayment period is more than 12 months. Any liability whose repayment is within 12 months should be reclassified to current liability. So under the current liabilities, you've got the trade payables. Those are what you've borrowed in terms of, mostly in terms of maybe the inventory that you've borrowed on, you've got on credit. Short-term borrowings, current tax payable, and short-term provisions, and any long-term borrowings which becomes payable within the next 12 months should be reclassified from non-current liability to current liability. So we start with share capital. The share capital, this is the capital which the owners of the business put into the business, or the investment they make into the business. This share capital can be distinguished between the following types of share capital. You've got authorized share capital, which is the maximum number of shares the company may issue. You have got the issued share capital, which is the number of shares actually issued to shareholders. You've got called up share capital, which is the amount of issued share capital the company has asked shareholders to pay for to date. And then you've got paid up share capital, which is the amount of called up share capital which has been paid for by the shareholders. The shares, they can also be classified into two types. You've got ordinary shares, which are also known as equity shares. These are the shares for the owners of the business. They have voting rights. Since they're the owners of the business, they can vote depending on the number of shares which they have in making certain decisions. The ordinary shareholders, they have no right to a dividend, but they receive what the directors decide to pay them. So if the directors decide that this year will not pay dividends, there's nothing the shareholders can do. They can't force things because they've delegated the running of the companies to the directors. Another class of shares is called preference shares. The preference shares, they've got a fixed rate of dividend. For example, 7% preference shares. So the rate of dividends will usually be just next to the preference shares themselves. These preference shares, just from the name preference, they receive dividends in priority to ordinary shareholders. So, if a company was to wind up, they'll be paid earlier than the ordinary shareholders. The ordinary shareholders will only receive whatever residue is there after everybody who the business owns has been paid off. So if the company, after paying off all what it owes, remains with nothing, then the ordinary shareholders will go home with nothing. So how do we account for share capital? We will illustrate in this example question. Let's take, it's the first time the company is issuing shares. And these shares have been issued on 1st January 2006, and 100,000 shares were issued. Each one of these shares is being issued at 50 cents. That 50 cents is what is also known as the nominal value. So when you see the word nominal value or par value, that's the value at which the shares are issued. This par value or nominal value of 50 cents will remain the same year after year. It does not change. Pay a lot of attention to that. The nominal value or the par value of ordinary shares does not change, it remains the same. And any subsequent new issues of shares should be recorded under share capital using the par value or the nominal value, in this case of 50 cents. Now, different companies will decide different par values. So 50 cents is not the norm. It can be 25 cents, it can be $1. So just pay attention to what you are given in the question. So 50 cents times 100,000 gives us $50,000. So the cash account will be opened with $50,000. The share capital account will also be opened with $50,000. Now, shares are issued at nominal. However, if the company is performing well, those shares can trade at an amount which is higher than the nominal value. So when you issue new shares, or when you issue shares at more than the nominal value, the excess between the nominal value and the par value, no, let me retract a bit. The excess, which is the market price, the price at which the shares are trading, so the excess between the market value and the nominal value or par value does not go to the ordinary share capital. You take it to the share premium account. So you open another account called share premium. So let's continue with this example. Let's assume now that more shares are issued, 200,000 ordinary shares are issued, but these are now issued at 80 cents each. The nominal value is 50 cents. So how are we going to record these new shares? The 80 cents should be split. So 80 cents times 200,000 shares, 160,000 cash will come in, which will be debited to the cash account. Then the 80 cents will be split between the nominal of 50 and the 30, which will go to the share premium. So 200 by 50, 100,000 will go to the share capital. 200,000 times 30 cents, 60 cents will go to the share premium account. So the share capital account will now be the new 100,000 plus the initial 50,000 to give us share capital of 150,000, and the new account called share premium account will now be opened in the statement of financial position. So we'll continue with this session in the second video.